Hi students, you're watching Reflections at Services online learning videos. Learn at ease with Deepa Sridhar, your super favorite teacher. In today's accountancy class, let's explore partnership accounting. To begin with, let's learn the fundamentals of partnership. If you give me a choice between employment and business, I would stand with business because, of course, business earns higher returns. Business can be established by anyone who invests capital and is ready to undertake risk. But a single man's capital, skill, management ability, risk-taking ability will generally be limited. To overcome this, two or more people combine and jointly share risk, enter into an agreement to form and run a business, and that's partnership. Let's see the characteristic of partnership. Two or more persons. There must be at least two persons to form a partnership, and such persons must be competent to contract. When I say competency to contract, they cannot be a minor, they cannot be persons of unsound mind, they cannot be persons who are disqualified by law. Agreement. Partnership is a result of an agreement. It can either be oral or it could be written. This agreement would form the basis for the rights and duties of the partners. Partnership can be formed for the purpose of carrying on some business with an intention of earning profit. So there should be a profit motive. A joint ownership of a property doesn't amount to partnership. Let's take a husband and wife owns an apartment, jointly owns an apartment. That is not accounted as partnership. Sharing of profit. There's an agreement between the partners to share profit in a predetermined ratio or equally. Partnership carries a relationship of principal and agent. Each partner acts on behalf of another. Each partner is an agent as well as a principal. Agent because he can bind the partners and the firm by his act. Now A and B are partners. B is signing a contract with C. So both A and the firm is bound by the act of B. So B has acted as an agent of A and the firm, and A and the firm has acted as the principal. So business can be carried out by all of the partners. Partnership is not a separate legal entity. Law doesn't provide partnership with a separate existence. So law, in the eyes of law, there is no separate existence for partnership. It is not separate from its partners. But from the point of accounting, while we are recording the transaction, from the accounting perspective, partnership and the partners are treated as two different entities. So accounts is seeing them separate. Law is not seeing them separate. Partners are jointly and severally liable for the debts of the business. Now let's take A and B runs a partnership business and they have a liability of 1 lakh. So that 1 lakh is a joint liability of A and B. They can agree to bear the liability in their predetermined ratio or equally. Now let's suppose A has become a bankrupt. A doesn't have sufficient funds to pay C. Now B will have to bear solely the liability of C. He cannot escape saying that he will only bear his share of liability. So that's why we call partners as jointly and severally liable. Now let's see the rights of the partners. Every partner has the right to share profits and also the losses with other partners in the agreed ratio. This we have discussed in the previous slide itself. Every partner has the right to take part in the conduct of business. This also we've already discussed. Every partner has the right to be consulted in the matter related to partnership. They have the right to be consulted on any important matters or all matters. Every partner has the right to inspect and have a copy of the book of accounts. So now there are few partners who doesn't want to get directly involved in the management or administrator of the business. But still they have the right to access the book of accounts, because book of accounts will tell how the partnership is performing. So you have the right to inspect and have a copy of the book of accounts. Every partner has the right to disallow the admission of a new partner. So admission of new partner is not based on majority. So we have 5 partners. It's not that 4 partners agree we can elect a new person as a partner. It is that all the 5 partners, there should be a consensus. We need to say all the 5 partners should agree to accept a admission of a new person as a partner. Every partner is a joint owner of the partnership property. See, now partnership is not a separate legal entity. So law doesn't allow a partnership firm, not a partner, no, partnership firm to own assets, be it land, building, equipments, property. The partnership firm cannot own an asset. It could only be owned by the partners. So assets of the partnership firm is jointly owned by the partners. If a partner has given a loan to the firm, he has the right to receive interest at an agreed rate. If the rate of interest is not agreed earlier, it would be paid at 6% per annum. If the partner incurs expenses or makes payment on behalf of the firm, he has the right to indemnify by the firm. So I spend for the firm will have to give it back to me. Okay. Every partner has the right to retire from the firm after giving proper notice. If you don't want to continue to be a partner, give them a retirement notice and you can withdraw. Okay. Since the partnership is an outcome of an agreement, it is essential that there must be some terms and conditions for partners. So such terms and conditions need not be compulsorily written. Meaning to say, the law doesn't say that the partnership agreement should be in a written form. But it is always beneficial to have a written partnership deed because it will avoid misunderstanding and disputes. So a partnership deed would become a legal document. It will outline the rights and responsibilities and terms of partnership. Then it will serve as a written document, or it is a written contract within the partners on how they're going to operate, what are the roles of the partner, what is the profit sharing ratio, what would be their decision making process. So the partnership deed can contain the following points, like the name and address of the firm, name and address of the partners, type and nature of the business, what is the amount of capital contributed by each partner, what would be the interest on capital which would be provided by the firm to the partners, how much can the partners draw from their profit, what would be the interest on drawings, what would be the profit sharing ratio, is any partner eligible for salary, if I'm going to calculate goodwill, how am I going to calculate, what is the method of valuation, what is the accounting period, what is the auditing method, what is the duration of partnership, what would be the bank account, settlement of disputes. So it could be anything related to how a partnership is going to operate. Most of the time what happens is a partnership business is started as a verbal agreement. Partners come together, they jointly invest, but they don't decide upon the terms and conditions. Or there is a partnership deed, but it is silent about most of the things. So in such instances, you will have to cross-refer the Partnership Act and apply as per the Partnership Act. So we will see the instances where the Partnership Act would be applicable on certain aspects. With respect to profit and losses. Profit and losses, in the absence of a profit and loss sharing ratio in the partnership deed, then profits and losses should be shared equally. Interest on capital. See, now when the partners invest their capital in the business, the firm would provide an interest on the capital invested. So that should be mentioned in the partnership deed. When the partnership deed is silent about interest on capital, you go up by the Partnership Act saying that there is no interest on capital allowed. Similarly, interest on drawings. Drawings is the withdrawal of the profit by a partner from the business. On such drawings, the firms will charge interest on the partners. So if there is no mention about interest on drawings in the partnership deed, then no interest of drawings is charged on the drawings. Salary to partner. If a partner is eligible for salary, that should be a mention in the partnership deed. In absence of that, go by the Partnership Act, which says no partner is entitled to salary. If at all a partner has lent a loan to the firm, in that instances, he will be eligible for interest. So the rate of interest is not determined or it is not written in the partnership deed. In that instances, go by the Partnership Act, which says the rate of interest for such loans would be 6% per annum. And others we've already discussed, no new partners can be admitted without the consent of the existing partners. Each partner can participate in the conduct of the business and every partner can inspect the book of accounts. I often tell this to my students that a good accountant should not trust their memory. There should be a very disciplined recording of all the transactions of the business. That's a best practice. So how to record the transaction is given by the double entry bookkeeping system. Every transaction influences two accounts. There is a debit account and a corresponding credit account. Hope you have learned what a double entry system is in your 11th grade. If in case you don't know what a double entry system is and how recording of transaction happens based on the double entry bookkeeping system, I have a separate video on double entry bookkeeping system. Please go watch that video and then come back. For those who know, we can continue. So, partnership records its transaction based on the double entry bookkeeping system. It prepares the year-end accounts, the profit and loss account and the balance sheet. Now, with respect to a sole trader, the entire profit of the business belongs only to him. But that is not the case with partners. It has to be shared amongst the partners, either in their predetermined ratio or equally. So, what is the basis of appropriating the earned profit of the business between the partners? We need to create an extension of the profit and loss account called the profit and loss appropriation account. Now, for example, the firm is providing interest on capital to the partners. It is charging interest on drawing from the partners. So certain aspects like salary, interest on capital, commission to partners is given to the partners, which is an expense to the firm, and certain aspects like interest on drawing is collected from the partners, which is income to the firm. So profit and loss appropriation account records all this, the transaction which happens between the firm and the partners, and then what would be the profit which is transferred to the capital account of the partners. So we will learn in a future video on how a profit and loss appropriation account is prepared. Once the profit and loss appropriation is prepared and the profit to be transferred to capital account of the partners are decided, we have to prepare the partners capital account as well. We'll see that in detail in the upcoming videos. So we'll learn more in the future. For more videos on accounts, economics, psychology and English, please subscribe to the channel. For any online classes, connect with me at reflectionsedu@gmail.com or WhatsApp me at 9790604789. Happy learning!